All right, good afternoon, everyone. Thank you for joining us for our March webinar with Gerard Zielinski. Before we get started, I'd like to address a few housekeeping issues. First, every CDFA who attends this webinar will receive 1 hour of CE credit. The credit will be placed in your account within the next 2 weeks. We will also be sending a recording of the webinar in a follow-up email tomorrow, so watch for those. And lastly, if you have any questions during the webinar, please enter them into the chat box of your GoToWebinar menu. We will get to as many as we can during the presentation, and you will get Gerard's contact information at the end of the webinar for any other questions you may have. Finally, a little about Gerard. He is a certified divorce financial analyst at Divorce Financial Solutions in Milwaukee, Wisconsin. Gerard's been working at DFS since 2007. In his work at DFS, Gerard has been involved in the drafting of over 5,000 qualified domestic relation orders and has performed hundreds of pension valuations. Gerard works as a financial specialist in divorce, and he provides support in litigation, collaborative, and mediation cases to educate clients on financial matters such as tax issues, maintenance, child support, and property division instant to divorce. Gerard received his bachelor's degree in business finance from the University of Wisconsin-Milwaukee in 2008. He is a member of the Institute for Certified He is a member of the Institute for Certified Divorce Financial Analyst. He is also a member of the Collaborative Family Law Council of Wisconsin and on the Public Education Committee for the Collaborative Foundation of Wisconsin. Now let's turn it over to Gerard.
Thank you, Brittany, for that introduction. That took a little bit away from what I was going to talk about here on this opening page here, but I do want to jump back into maybe a little bit about what our company does, so that way you guys got an idea of how pension valuations maybe fit into the landscape here and what we do. It's a family-owned business. Divorce Financial Solutions is owned and operated by my brother and myself, and we also work with my father, Garrick Zielinski. So we have a ton of experience here, and I would tell you everything we do, our agenda, we're unique in that our agenda is 100% divorce related. So we don't have outside agendas. We're not money managers. We're not financial planners. Everything we do revolves around, I guess, helping clients that are going through the divorce. So we're unique in that sense, and we're also unique in the sense that we have such a high volume of work coming through our office in different areas. So pension valuations are really just one area that we practice in. It's a profitable area of our business. We charge between $200 and $250 for each pension valuation that we perform. But I would tell you, between the three of us, Garrett, Grant, and myself, we're performing hundreds and hundreds of pension valuations per year. Over the last 10 to 12 years that we've been doing this, that's thousands of pension valuations that we're performing. So we have a lot of experience. But with that, with that volume, it also brings, I guess, court appearances. So we're well versed. We've been expert witnesses in testimony and in court testimony for hundreds of cases. We don't go to court on every pension valuation we do. In fact, it's lower and lower each year. I would tell you, the more and more that we're staying consistent with our valuations, and the courts are kind of recognizing our valuations, it's less and less. But if you're thinking about performing pension valuations, doing them on your own, providing them to attorneys or folks that are working in divorce anyway, that's something to think about and be prepared for. Expert witness testimony is it's going to go hand in hand with performing these pension valuations. So if you're not comfortable in that type of situation, you might want to think about what you're going to be writing in your report, and you think about doing these pension valuations. So just a little bit of a background on our company. You notice the title of the program today, How Tenable is Your Valuation? I only have 45-50 minutes here to talk to everybody today, so it's going to be virtually impossible for me to teach you exactly how to do a pension valuation. So the title of the program is really meant, or the program is really meant to discuss some of the factors, some of the assumptions that are used, and how everything kind of comes together in doing a pension valuation, just to get you all a better idea relatively quickly on how tenable that valuation is you're either going to perform or looking at. How acceptable is that valuation, or I shouldn't say acceptable, but how appropriate is that valuation for the particular case you're working on. And when I go through some of the things today, we're going to talk about the factors and assumptions. We're going to look a little bit at the history of where these pension valuations came from, what they were, how they were done in the past and where they're at now, and why a pension valuation is needed. And again, once you kind of get a good idea of all those factors and assumptions and all those reasons where or why these valuations are needed, it's going to help you in determining, again, how appropriate that valuation is for your particular case. So before I get into the program here, you'll notice a quote on the very bottom. This is a quote that rings true in our office on a daily basis. It's directly from my father, Garrick Zielinski, who's been in this business for over 30 years. He used to be a money manager, but often would work as a consultant to attorneys on their divorce matters, even during those times. So he's been saying this forever. I've been hearing it for as long as I can remember, and I really believe it holds true on most everything we work on here in our office. In addition to the attorneys that you might end up working with, this is something that holds true in how they operate and how they treat their cases too. But discovery, analysis, and evaluation should be completed before the negotiation or drafting begins. In this case, I believe this type of discovery and analysis and evaluation should be done before the valuation begins. But I believe the discovery part of this quote really holds true. A lot of folks just want the value. They call you up. They don't want to report. They want the value, and then they're going to go put that value on their balance sheet and use that pension value, to determine the outcome of that divorce or the property division settlement. That's fine if that's how you want to practice, but I really believe one of the biggest pieces to valuing a pension is really understanding the type of benefit or plans that you're going to be dividing. So what that statement is really saying there is, don't put the cart before the horse. Do your homework, do your research, figure out what you're dividing and how that benefit is paid, how that benefit is calculated, and figure all that stuff out. Do your discovery before you begin your analysis. So it brings me right into my first slide here, and I want to talk a little bit about the types of retirement plans that you're going to see and deal with. Oftentimes, they're employer-sponsored plans that are looking to be valued, or that attorneys are looking to value, are these employer-sponsored plans, defined contribution plans, 401ks, IRAs, stuff like that, and defined benefit plans. You see, I don't have any too much listed here on a defined contribution plan. That's because we don't often perform valuations on defined contribution plans. We're often asked to provide or calculate a present value on a defined contribution plan, but it's typically not needed because those defined contribution plans, the value of those plans are already known. Those defined contribution plans, 401ks, stuff like that, there's account statements, there's statements and values that are readily available daily. In terms of valuing those plans, they are what they are. You can look at a statement and you can figure out what the value of those plans are. The most common type of plans that you're going to run into and benefits that you're going to be valuing are defined benefit plans. These are more commonly referred to as pension plans, retirement plans, benefit plans, not to be confused with IRA annuities, but often people do refer to pension payments as the stream of pension payments as an annuity. So, when you're looking at a defined benefit plan, how do you identify what you're looking at? It's often a plan that is overlooked by clients, attorneys, even the employee in that specific pension plan. They're often overlooking this type of benefit just because it's not like a defined contribution plan. They don't get an annual statement. They don't get statements. They can't see the amount that they're going to receive in a monthly pension benefit. They don't see that daily. So some government plans, some plans do, provide their employees account statements or annual statements of benefits that talk about their pension plan. But often those statements are confusing, and they're cluttered with other plan information that isn't really applicable to determining their monthly benefit due to divorce. So sometimes a lot of times those statements are no good. They're not of any use. So again, just identifying this defined benefit plan, you're looking for an accrued monthly benefit. What have they earned to date? They're working. They have years of service put in, and each year of service is contributing to their total monthly benefit at retirement. So a defined benefit plan, the benefit or the monthly amount that you're going to be paid is known. It's known now. It can be calculated, after 5 years of service or 5 years into your work history. You can calculate that monthly benefit, and you can calculate it for every year after that, just to determine what you're going to be paid at your retirement date. What is unknown, really, in this sense, is the money or the contributions required to fund that benefit. So that's going to change over time depending on interest rates and stuff like that. The money that's required to fund $1,000 a month benefit is going to be different and change over time. So what we're really talking about here in terms of this pension plan is a monthly benefit payable at a future date, and it's payable for one's lifetime. What you have to understand there is it's a promise of a monthly benefit, and this is maybe one of the reasons why you need a pension valuation. We don't know the cost, and we don't know what it's going to cost or what the value is to pay out that monthly benefit starting at age 65 or earlier, or whatever they choose to retire. But that's maybe the reason why you're going to need a pension valuation. So once you've kind of determined what type of benefit you're dealing with and that it's going to require a pension valuation, one of the more important I guess discovery pieces to this whole valuation is the terms and conditions of the plan. So you have your $1,000 a month benefit. Now you need to know all you can know about that benefit in terms of how it's calculated. You're going to want to know when the plan's normal retirement date is. Are they eligible to retire early? Are they eligible to retire with subsidies that may need to be included in the valuation? Are they eligible to retire early with unreduced benefits? All of those things you're going to find in the terms and conditions of each of these plans. All of these defined benefit plans are going to be different. Government plans and certain specific plans may have earlier retirement dates. Instead of age 65 as the normal date, it's age 60. And again, you're going to need to know that because it's obviously going to affect the valuation. So very important to do all you can to get summary plan descriptions from these companies that you'll be valuing plans with. Invaluable information down the road. One of the things you can also find out in this discovery process is how to calculate that monthly benefit. So if someone doesn't know what they've earned to date, and you know how that plan actually calculates that monthly benefit, maybe it's based on a formula of average salary and years of service. If you have those factors and you know that formula, you can calculate that benefit for them, just like the plan would otherwise do. This also is going to come in handy down the road or down the line if you're asked to perform marital portion calculations. If you're asked to do those type of calculations, oftentimes you may have to calculate the benefit as of the date of marriage on your own, because that benefit information just isn't available at that time. So knowing these terms and conditions of the plan, it'll help you go a long way in determining, I guess, how to perform this valuation. Let's put it that way. So once you've identified the type of plans you're going to be valuing, and you're comfortable with the terms and conditions, you might ask yourself, or you might be asking, well, why do I need to value this benefit? So you know John Doe is going to receive $1,000 a month at age 65. Well, why do I need a valuation done? Why can't I just work through my case and use the $1,000 a month benefit that I know about? One of the first reasons, and there's actually two reasons that I'm going to get into on why you need to value these benefits, but one of the first reasons I always point out, and I think it's more or less maybe to scare the bejesus out of any attorneys that may be listening in right now, but it's a Wisconsin court appellate case from 2001, Wetstad v. Wetstad, and what that case basically says is if you do not include the present value of a pension plan within your property division settlement, that pension plan or that asset and the income from that asset can be later used to count as income for purposes of fixing, maintenance, or support. So, what that's really saying is if you're going to divide a pension plan within a property division settlement, you're going to divide it 50-50. It's not good enough to just put the pension plan is going to be divided in half in your marital agreement. You're going to want to go take the extra step and get that valuation or get a number and get that number into that marital agreement, and that's the only way to exclude your client or that person from being subject to later counting that pension income for purposes of fixing maintenance. So if you're understanding property division and support, if you divide that pension by quadro under the property division settlement, it's an asset. It's treated as an asset. It's not going to later be double counted and used to determine support or any maintenance obligations. So again, if you don't have that value in the property division settlement, it can later be counted as income, and that's really doing a disservice to your client. I don't know that this is something that you're going to be writing or needing to know for your reports, but it's more or less, a tip, something in your back pocket that you can use when you start dealing with attorneys and educating your clients as to some of these pitfalls that they might run into. I think it's just a trust builder to know something like this when you're working with attorneys. So watch out for the Wetstad v. Wetstad case. Again, that's probably the number one reason, why you need a pension valuation. But the more common, I guess, reason why you may need a pension valuation is to explore the immediate offset method. So if you haven't heard of the immediate offset method before, the immediate offset method simply compares the value of a pension plan to other marital property. So for instance, a retirement plan participant would keep, let's just say, 100% of their pension in lieu of other values or other property values in the marriage. So you're going to get a pension valuation done to compare the value of that pension to maybe net equity in the home, in the marital estate. You might be comparing it to other defined contribution plans or other retirement assets in the marriage. And that's what you're doing when you're exploring the immediate offset method, is comparing that value to other values. What you're really doing, again, an apples to apples comparison, right? If I asked you, what would you rather have, $1,000 per month or an $80,000 defined contribution plan, both of which would be on your marital balance sheet? A lot of people can't answer that question. We don't know what's more valuable. Is the $80,000 defined contribution plan more valuable, or $1,000 a month at a future date? What's more valuable to you? So you don't really know without getting a PV. And I think the risk associated with making such a decision can't be overlooked. So when you're exploring the immediate offset method, you need to know about other assets in divorce. You need to know about these assets that you're comparing values to. Net assets in home equity or cash accounts versus maybe deferred tax arrangements or accounts that have deferred tax implications. You need to know and be able to explain to your clients and the people that you're working with what type of decision and what the risk in that decision may be, what type of decision you're making by exploring that immediate offset method. So the fallback, and I'm not going to get too deep into the fallback here, the other option that you have when you're looking at these pensions plans, but you know, the other option is dividing it by quadro. And that doesn't have anything to do with evaluation here, but often when you're exploring the immediate offset method or looking at getting a pension valuation done on a particular monthly benefit, you're often answering these type of questions as far as, do I divide this pension, or do I offset it with other property? And there may be reasons why you decide to divide these pension plans by quadro before you even get a valuation. Now, WETStat v. WESTStat should kind of tell you otherwise, and that you need a valuation either way. But sometimes you may determine right off the bat that these pension plans don't need a valuation, and we're going to divide them by quadro. Some of the reasons why you may divide these things by quadro. Maybe you have a late in life divorce clients who are really looking at these pensions more as income, and you're going to divide them in half just to start to equalize income there. Some of the other reasons may include let's just say not having significant other assets in the marriage. So someone who has a large pension plan or even a small pension plan, but they may not have any home equity. They may not have any other assets, defined contribution plans, savings accounts, and there's nothing really there to offset those dollars with. So it may be determined early on that you just don't need a pension valuation. We're going to divide this thing by quadro. And then last, I think once you learn the assumptions and the factors that go into these pension valuations, you'll be able to determine if that valuation is appropriate for your case, and you may learn that you're not comfortable with some of these assumptions and some of the risk involved with that offset method, and that may be why you determine, okay, we're going to divide this by quadro. So you'll learn about some of those factors, and you'll kind of be able to determine on your own later on if that is the case. Maybe you have a specific matter or case going on, and one of the assumptions just doesn't fit with that case and how that valuation was done, and again, it can't be trusted, and there's some risk to both parties by using that value and offsetting those dollars with other property. So you're going to look at dividing it by quadro. So so knowing why you need this valuation will bring you really one step closer to determining the right settlement approach. That's kind of the bottom line of why. So once you've done your discovery, you've determined why or what purposes you need this valuation for, you can technically really begin your calculation, I think. But before I get into the meat and potatoes of the actual calculation, I do want to just briefly discuss a quick history on where these factors are coming from and how these pension valuations came to be today, because I think it's important to kind of understand that and know why and where we're getting the things that we're using within these pension valuations. So there is two different ways to value a pension: an economic and an actuarial valuation. And there wasn't always guidelines for these valuations like there are today. So back in the 1980s, early 90s, well before my time anyway, there was a large clash, or a large clash in the courtroom, let's just say, or let's just say a large amount of these cases going to court because of the vastly different guidelines being used, and in turn the vastly different outcomes that people were getting in terms of valuing these pensions. So early 1980s, again, the two valuations were clashing in the courtroom, and it was really a big mess. There was values at one extreme and the other, and the judges are throwing their hands up. They don't know where to lie. These differences in opinions caused a great deal of litigation, and in turn, what you're going to get from that is what I'm going to talk about next, actuarial rule number 34, that was created in 1999 by both economists and actuarial pension valuation preparers, let's just say, and basically they came together to create this rule and the standards that we now do valuations by. But just a quick little history on the difference between the two, because you're still going to see folks use economic valuations today. The amount of times that we see other valuations from other, professionals, or the amount of time that we're in the courtroom, we certainly see folks come in with an economic valuation. But just to kind of give you a big difference or a little bit of a background on the differences between the two, I won't go through this whole chart word for word or line by line here, but that chart kind of gives you all the differences. I want to stick to maybe the major difference here between the two, and that's the use of the life expectancy and mortality tables. So with an economic valuation, what they're doing is using these life expectancy tables and mortality tables to determine a fixed date of death. And what that does, what they're doing there is they're looking at a 50-year-old employee in 1995, and that person, based on the life expectancy tables, is expected to live until age 80. And so what they're doing in an economic valuation is cutting off or stopping their valuation at age 80. That means they're doing that valuation without any probability of someone receiving that payment at age 81 or the month after their 80th birthday, right? So I look at that, and there's a big problem, I guess, with that way of thinking. They're using the law of averages. What they're saying is 50% of the population is going to die before age 80. 50% of the population is going to live past age 80. And my question, or I guess what I like to say here is, nobody, and I shouldn't say nobody, but there's a very small contingent that dies on their 80th birthday. So which one of these clients, or which one is your client? Are they dead before 80, or are they living after age 80? And again, I think there should be some probability of receipt of payment past a specific age of death. So certainly that's maybe the first point I'd like to make about an economic valuation is if you see these in the courtroom, or you see a valuation that's based on a specific date of death, they should lose in the courtroom 100 times out of 100. That's just not the way to do it, and that's where the actuarial valuation comes into play. And what the actuarial valuation or calculation does is use these life expectancy tables to assign a probability of receipt of that next payment. So if you're age 65 and you just started collecting your pension, the probability that you'll receive that next payment when you're age 66 is very high, and they assign a high probability of receipt of that next payment. If you're age 95 and you're still living and you're receiving payments, the probability that you're going to receive your payment at age 96 is very low compared to, let's just say, a younger person. So in an actuarial valuation, what they're doing is again taking each payment, the probability, and assigning a probability of receipt of each payment. So they are using a probability that someone will receive that payment at age 81. Instead of fixating on a date of death, they're going to assign a probability. These tables go all the way out to, I think it's age 105. So you go all the way out to age 105. There's obviously a zero chance they're going to receive that payment. I think right around age 105, 106, 108, you begin to see zeros. There's a zero probability or a high chance of mortality that they're not going to see a payment at that age. So basically, again, it's the probability in you're assuming that you're going to receive each payment, but discounted based on the chances you're going to collect that payment as you get older. And I'm going to show you that calculation in a little bit more detail in just a bit. But one of the other major differences in the valuation process from years past to where we are today, I guess, is the acceptable mortality tables to use. So I'm going to explain a little bit of the difference between mortality and life expectancy and how that's used in this valuation. But the mortality tables, you'll see economic valuation used life tables and other national vital statistic tables. You know, those type of tables have insurance premiums built into them, other costs built into those tables and those rates. So essentially, when you're using those type of tables and doing an economic valuation, essentially what you really are doing is valuing the cost to the company or the plan to pay out that monthly benefit. And I don't know that that's exactly what we need when we're looking at these values of these pensions due to divorce. So we're not too concerned on what it's going to cost those plans and those companies to pay out these pensions, but that's the kind of valuation you were getting, you know, 20, 30 years ago, and they were really overinflating these values of the pensions and looking at it more as a perspective from the plan versus maybe the participant or the employee who's receiving this benefit in a divorce. So the actuarial standards, the actuarial valuation and the standards that were kind of brought about with actuarial rule number 34 kind of emphasized acceptable mortality tables that could be used. You know, there's all kinds of different mortality tables that can be used, and you may just have to decide which one fits your case best. There's mortality tables that are based on race and gender. Some of them are based on you know, disability. Some of them are based on short-term life expectancy. Some of them are based on you know, the type of working class that you're in. You know, folks who sit behind a desk, or the you know, the white-collar worker, you might be using a different mortality table than someone who goes out and risks their life and puts their life on the line for their job every day. So there's different acceptable mortality tables. You really just have to choose those tables depending on, you know, your case. Actuarial rule number 34 was created just to start or get some sort of industry standard. And I think, again, these actuarial evaluators and the economists got together and through the Board of Actuarial Standards created rule number 34. And if you are going to be doing pension valuations on your own, or you're going to start doing valuations, you want to value these pension valuations, this is probably the number one thing to familiarize yourself with. If you take anything away from this webinar today or this program today, it's to get yourself familiar with this rule. It really provides a guideline to anyone interested in retirement plan valuation. So you don't have to be an actuary to use this rule. It's guiding anybody interested in valuing retirement plan benefits. And it talks about the role and the responsibilities of the expert. It also discusses the factors and assumptions that are used into doing a pension valuation. So you're gonna find guidance on you know, the date on which you value these pensions. You're going to find guidance on, you know, mortality tables and interest rates and stuff like that. So I believe that this rule really, you know, standardized the industry in terms of what you're going to see now today in terms of pension valuations. It brought some consistency, you know, to those valuations and the standards that you're going to be using, so that you know, you're no longer using life tables that are designed for the plan. And I do believe it probably cut down on the amount of litigation and fighting that you saw in court. So I do believe this rule number 34 is kind of the end all be all in terms of the guidelines you should be following when doing a pension valuation. So once you familiarize, you know, yourself with that rule number 34, you're off and running. You're ready to go and perform your pension valuation. So I want to just discuss quickly here some of the factors and the assumptions that go into your pension valuation. Okay, so I'm going to start with interest rates. There's really 5 factors that are going to affect your valuation, and here I'm going to start with interest rates because I believe it's probably the most critical of these assumptions. It's probably the single most important mathematical relationship to understand. So there's kind of an easy way to understand this, but it's an inverse relationship. So I'm just going to tell you, the lower the interest rate in a calculation, the higher the present value, and conversely, the higher the interest rate used, the lower present value. And all that's really telling you, again, that's an inverse relationship there that's maybe tough to understand on the surface, but all that's really telling you is that at a time when there's low interest rates and you're using low interest rates, it's going to take a larger lump sum of money to meet that monthly obligation, that $1,000 a month. How much is it going to cost to pay someone $1,000 a month for the rest of their life? In low interest rate times, it's going to take a larger sum of money to do so, and in high interest rate times, or when you're using a higher interest rate, it's going to take a lower sum of money to pay out that monthly obligation. So that's, again, very important to understand. Once you've kind of understand that relationship, I think the most common question you'll get, or a lot of questions we get, are, where do you get these interest rates from? How are you determining them? Why are you using these interest rates? And I often revert back to rule number 34 and their guidance, but within rule number 34, they guide you to risk-free rates of return. And U.S. Treasury bonds or U.S. Treasury rates of return that are backed by the FDIC are often used and accepted, and also other high-quality corporate bond rates that have risk-free rates of return are used. So I also, answer that question and look at this in a more of a logical manner too. When I look at these pension benefits and the defined benefit plans here, you're talking about, you're talking about a lifetime benefit. So when I'm valuing a pension or a lifetime benefit, I'm looking at a long-term rate. So, I'm not going to go look at a high-quality bond rate for 3 to 5 years or 3 years. I'm looking at a 30-year bond rate or a 30-year rate of return because that's one of the longest risk-free rates that are out there. So if you're looking at, a different type of payment, maybe you're not looking at a defined benefit plan, but you're valuing, a buyout of support or something to that effect, you may be looking at a different risk-free rate of return, a shorter term rate. Let's just say you're doing you're valuing a 10-year buyout. Now you're looking for a rate that maybe is applicable to that length of the term. But again, with these pension valuations, they're typically lifetime, and you're going to use the long-term rate. So in our office, we use what's called the Moody's AAA corporate bond rate, and that's just it's a risk-free rate. It's a corporate bond rate, and it's just got a low degree of volatility over, let's just say a 3 to 5 year period. So we're not going to have such highs and such lows by using that type of rate. So that's where the interest rates are coming from. The next factor that may affect, that is going to affect your valuation is mortality. And when I talk about mortality, it's not to be confused with life expectancy. And I'm going to get into duration in just a second here, but mortality is basically the period of time and the probability of death prior to commencement. So you have a client or the person you're valuing that pension for is 45 years old. Their normal retirement age is 65 years old. And the probability, there's a probability of death between age 45 and 65 before he ever gets a chance or she ever gets a chance to collect that pension. Pensions are promises of future benefits, and a requirement to collect it is being alive long enough to do so. So the mortality is really determining what are the chances and the probability during that deferral period, during that period of your age now to commencement on the chances of death at that point. Not to be confused with life expectancy, which really is once you begin receiving that payment, how long are you expected to live and what's the probability of receipt on those payments. So in our office, we use a mortality table, RP 2000 tables. The reason I guess we use those because they are based on working class. So when you're looking at the probability of death between, now and commencement, you're looking at, that maybe their place of employment. I don't know that age and gender and all that matter too much. They're built into those tables, no question. But we use ones that are more of a working class table, blue collar, white collar, no collar, and RP 2000 provides all of those different tables. And again, according to your case or the appropriateness of, the use of those tables, I guess, should be appropriate for the case you're working on. But again, you can explore all the tables and graphs that are rule number 34 kind of guides you to. So the next factor that is going to affect your pension valuation is duration. And this is a very important relationship to understand as well. There's a period of your present age or your client's present age to retirement, which we kind of just talked about. That's called the deferral period. Okay, so you have that period. He's 45 now. His normal retirement age is 65. He's got 20 years to live before he can collect that pension. And then the other period is the payout period, which is your retirement date to your expected date of death. Again, we're not pinpointing the exact date of death, but we're using life expectancy tables to determine the probability of receipt. But I put together a nice graph here to kind of illustrate this relationship a little bit more. What I want to point out is the mortality discount is the probability of death before retirement. So on this graph that you see here, we have a participant who's 45 years old. His normal retirement age is age 65. This goes all the way out to age 85, but that's just for purposes of illustration. This graph is all going to go all the way out to age 110, 130, 120, whatever it is. It's going to be adding those probabilities. So the longer, I guess the general rule to kind of understand is the shorter the deferral period, this period here, that means the longer the payout period is assumed to be, and that will produce a higher valuation, okay? The longer the deferral period and the shorter the payout period is going to produce a lower present value calculation. So if you have a client who's 60 years old, okay, and our graph is going to start right here at age 60, well, the deferral period is very short and the payout period is expected to be very long. That's going to produce a higher present value than if you have a client or an employee who's 38 years old. A lot can happen between age 38 and age 65 where they might completely lose the ability to collect that pension. So there's a lower present value to that amount. So you might have a 38-year-old who's accrued $1,000 a month. You might have a 60-year-old who's accrued $800 a month. And the reason why you need a pension valuation is because of all these factors that are going to affect the value. The $800 a month at age 60 is going to be more valuable than that $1,000 a month for that 38-year-old. So understanding that relationship, that duration period relationship is important in knowing maybe why you're getting some of the values that you're coming up with in these pension plans. We see large monthly benefit information all the time, and it may be a high-paid executive employee who's a lot younger, 30, 35, 38, 40 years old, and everybody's asking, well, that benefits $4,000 a month. How can it not be worth as much as it is? But it's because of the mortality discount and the chance that they're going to die before they get a chance to collect that benefit. So moving on, a couple of the other factors that are going to affect your valuation, and I'll get rid of the obvious one pretty quick here. I'll walk through that quickly. Is the dollar amount. The dollar amount, all else being equal, it's pretty obvious. If you have a $2,000 a month benefit versus a $1,000 a month benefit, it's pretty obvious is what's more valuable, and that would affect your valuation. Now, you notice I said all else being equal. We know everything is not equal. We know the ages aren't equal. We know the normal retirement dates aren't the same. We know the terms and conditions of the plan aren't the same. So everything's not equal. And again, that's another reason why we're going to need this pension valuation. Last factor here that we'll talk about is the tax discount. I do believe it's probably the most debatable assumption used in the process. So it's very hard to put your finger on a tax discount. And one of the questions we most often get is why? Where did you come up with that tax discount? Why are you using that tax discount? You know, you can look at their tax bracket now. You can look at their tax bracket and what it might be at age 65. But now you're making a different set of assumptions. You're assuming when they're going to retire. You're assuming when they're going to collect. You're assuming they don't have significant income in their retirement years. You're making all kinds of assumptions that you really you don't know, and maybe that's why it's so hard to pinpoint. But what we do know is taxes are going to change. The tax code's going to change. So basically, it's just an uncertain, uncertain calculation or factor, I should say. And one of the rules of thumb that are currently being employed by evaluators or people that work in this industry is using a 20% tax discount as kind of the default. And the reason being is because that is the withholding required on any distributions from an employer-sponsored plan or a qualified plan. So if you have take money out of a pension plan or take money out of a defined contribution plan, or you, again, commence your pension plan, begin collecting, employers are required to withhold 20% towards your federal tax liability. And I think maybe that's why that's where we default. So the default rate is, again, 20%, unless, you or maybe a tax preparer or somebody that has some knowledge on taxes would have to come up with a suitable discount rate that and that can be determined otherwise. So again, the default's 20%, and unless you find an applicable rate or an appropriate rate to say otherwise, that's usually what you see. So those are the 5 factors that are going to affect this valuation. And I don't know if I'm running out of time. Maybe somebody can let me know, but we're probably approaching 50 minutes, so I'm going to kind of just burn through this real quick.
Yeah,
we got to the end here.
Left.
Okay, so yeah, we got to the end here. This is kind of an example of the pension valuation that we prepare here in our office. You could see at the top here are all of our factors and our assumptions. We're assuming the payment start dates at age 65, the date that they can receive these benefits unreduced. I wanted to hit on that again real quick. Rule number 34 is guiding you to use the unreduced benefit date. So, typically the normal retirement age 65, that's what we're going to use. When these plans calculate benefits, they're not calculating a benefit with a reduction for survivor benefits, or they're not calculating a benefit for early retirement or assuming early retirement. When you're working and you're accruing monthly pension benefits, the calculation is based on the single life amount, the unreduced amount, and again, at the time that you can receive unreduced amounts is typically normal retirement age 65. Plans have different terms and conditions in the sense that, maybe you have 20 or 30 years of service and you can retire early with an unreduced benefit. So those are things you're going to want to know, but here's kind of a look at how we perform our valuations. We type in the facts that we know on the case, the $500 a month benefit, and now we can change our assumptions, the interest rates, and tax discounts. But what we're really doing in the background of our program, and what you're really doing here when you want to calculate this benefit, is you're really calculating the future value. Okay, so you have your payment age start date age 65. You have your payment starting on that date age 65. It's discounted for interest rates and mortality, and discounted in the sense that they're assigning a probability of that next payment being received. You can see here I've only went through 21 payments, but if you can picture this type of an Excel spreadsheet, this is going all the way out to age 135. So we're at age 66 here. That's 21 payments. You know, it's going all the way out to age 135. By the time you get out to, let's say, 98, 99 years old, the probability is very, very low. Once you pass up age 100, you're basically seeing zeros in this column. But all you're really doing when you're doing the valuation is adding up the sum of this column. So you're assigning a probability of receipt of every payment from age 65 to whenever they're going to die. Again, not keying on that date of death, but you're assigning a probability that they're going to receive that, and add up the sum of all of those payments to get your future value. So right here you'll see the outputs that we show on our valuation. Present value as of 12/1/2026, his expected retirement date. That is the sum of all of those payments added up. And to simply bring that back to present day dollars, you need to add in that mortality discount that we talked about, the probability of death before commencement, and factor in your tax discount. So those are the three values that you see there. Here's the present value after your mortality. Here's the present value after taxes. So that's basically it. We get you down to your present value calculation there. What I do have to talk about real quick, and hopefully I have some time here, maybe a few minutes I can just kind of run through this, but the premarital portion, it's a big component of, often a big component of what we're asked to do. So when we're asked to do evaluation, most of the time, I would say 50% of the time, we're also asked to determine the marital value of that benefit as well. So I want to just point out that premarital portion calculation is completely separate than a pension valuation. You want to be familiar with your state regulations and common practices in your area, because you might need to do this premarital portion or break out the marital portion and value that only. You might need to do that in 100% of the valuations that you perform. Wisconsin, where I'm at, is a marital property state, so we don't need these marital portions, but what we'll see is a lot of short-term marriages. They're trying to break out the marital portion of those pensions, so that's where we're getting involved. But you may need to understand this marital portion calculation for absolutely every valuation that you do. So it's important to understand, I guess, the differences between the two methods, the direct tracing method and the coverture fraction method. It's also important to understand how these benefits are calculated by these plans. Some of them accrue on a linear basis, some of them accrue on a nonlinear basis. And just to give you a quick example of that, a linear accrual would be a plan that pays out $100 or a fixed monthly amount for each year of service or each month of service. So in your first year, you're earning $100 towards your monthly benefit. In your 30th year of service, you're also earning $100 towards your monthly benefit. That's a linear straight line accrual. Every year is treated the same. Those pension plans are few and far between. I can think of some union employee pension plans that accrue in that type of a linear accrual, but most of the pension plans that you're going to see, 90% of them are non-linear accruals, and that just means the first day of work or the first year of service is not counted or factored the same as your 30th year of service. Everybody's heard the term exponentially, and then a non-linear accrual is an exponential accrual where, again, the later years of your service are worth a little bit more in terms of what you're accruing to your monthly pension benefit, and that's because of the way that plans calculate benefits, right? A linear accrual might be something to the effect of a formula where it's a percentage or a multiplier times your average salary times your years of service to kind of come up with that benefit. They're not treating each day the same. So it's important to kind of know the differences there. Just some illustrations, and you guys can look back at these. I'll kind of burn through them real quick here, but a coverture fraction method and a direct tracing method, those are the two methods which you can use to calculate a marital portion. The coverture fraction method treats each day the same, okay? So if you're looking at a plan or you're valuing a plan that accrues on a non-linear basis, I don't know that the coverture fraction captures exactly what you're looking for. It treats each day the same, whereas the direct tracing method, it gathers data for each year and accumulates that data over a period of time. You could see both of these folks earned a $1,500 a month monthly benefit, but when you look at the marital portion, 10 years married out of 25 years total, The coverture fraction is going to treat each year the same and divide, the total number of years in marriage divided by the total number of years in the plan. Okay, so 10 divided by 25, you're going to get the $900 marital portion value. You're going to get something completely different if you use the direct tracing method. You're going to get a different value because, again, you're really valuing, or you're tracing that specific period in time. It could be this first 10 years, it could be this last 10 years. You're going to get a different value. I would tell you that the direct tracing method is really the more accurate way to do this. It's a more accurate calculation, but oftentimes we fall back and use that coverture fraction method because we don't know, or we can't obtain the information as of the date of marriage that's needed. So just another quick example of maybe a linear and a nonlinear accrual. You can see here's the facts of the case: 10-year marriage, 25 years of credible service. You can see the difference between the direct tracing and the coverture fraction method again. You've calculated the premarital portion the first 15 years. You've calculated the last 10 years when they were married. And now you've determined their total monthly benefit. Using the direct tracing method, you can subtract that premarital portion from the total monthly benefit. Your marital portion is $1,275. That's what you're going to be valuing in your valuation. Versus if you use a coverture fraction method, you divide the 10 into 25. Only 40% of that 1875 is marital. 40% of that is 750. So two drastically different values that you're going to get and that you're going to go on and value. It's going to be good to familiarize yourself if you're doing these valuations and somebody asks you to calculate the marital portion, the marital value. You have to familiarize yourself with these two methods, and also familiarize yourself with how you're going to gather the information and data to perform the two. So here's a linear accrual. You could see that the outcome is exactly the same because, again, they're treating each of these years as equal. Again, most of the pension plans that we see are not going to be accruing on a linear basis. So I kind of blew through that real quick just to make sure we have enough time for questions here. Last, you guys are all going to get a copy of this presentation, so just something for you to look at. I call it maybe a rule of thumb checklist, but just some factors and assumptions and how they affect those present value calculations. So again, if you're looking at a valuation and you're trying to figure out if it's appropriate for your case and how tenable is that valuation, you can maybe just use these rules of thumb. The role of the expert, I kind of mentioned, and also in my bio that Brittany mentioned what our roles are. Pension valuations are really just one piece of our business anyway. But I would tell you that in terms of being an expert in regards to doing a pension valuation, you're going to usually provide expert reports, but they also can be used for support in litigation, mediation, collaboration, cooperation. So we wear a bunch of different hats, and we value these pensions in the same manner. We don't, depending on the client, depending on the situation, our valuation isn't going to change. But one thing to kind of just be aware of is be prepared for that expert witness testimony. I think this is probably one of the most highly litigated issues in divorce. So be prepared to go to court or be called in as an expert witness when you're performing these valuations. Our firm, we also draft a ton of quadros. We draft domestic relations orders for just about any plan you could think of, and we consult. So Garrett Grant and I sit down with clients and consult about the tax effects of property division and support and stuff like that. So that's just a little bit of more of a review on our role in this whole process. So that's what I have for you today. I thank you for listening in. I hope you learned something, and I'm prepared to take some questions now. I think we're just about out of time. Am I not right?
You are. One of the big questions that everyone is asking is if they can get a copy of the slides after the webinar.
Certainly. Are you going to be sending that to everybody, Brittany?
I certainly can in the follow-up email. I most definitely will. So if you send me over a copy, I can get that.
Yep. And I haven't got, that's why you're asking, because I haven't got you a copy yet. So I will get that to you, and I will get that to you, and yes, you can disperse that, no problem.
Okay, so we do have a few questions. I'm only going to be able to say like a couple of them, but we'll start at the top. Is a TIAA annuity a defined contribution plan, or is it a pension plan? And
It
how?
sounds like, yeah, it sounds like they're dealing with a TIAA annuity. That is technically a defined contribution plan. The way that you can, figure that out is looking at the statements, the account balances. There's probably no monthly benefit payout attached to that type of a plan. It's most likely got an account statement with account balances, and those account balances are subject to market fluctuations on a daily basis. So that's kind of what you're looking for there. From what I know, or what the question that was asked, and what I can tell, is they're most likely dealing with the TIAA defined contribution plan.
All right. What about pensions moved to the pension guarantee fund?
Sure. So those can be valued in the same manner. All that means is their pension fund went under. They don't have enough money in their pension fund to pay out all the monthly obligations under that pension plan. So it would be taken over by the PBGC Corporation, and all they're doing is guaranteeing that those monthly benefits get paid. What you need to watch out for is a reduction. So just because PBGC takes over, it doesn't mean they're always going to receive 100% of that monthly payout that they were intending to receive. Some companies and some plans, they still do receive 100% from the PBGC, but it's a good idea to learn if there is going to be any type of reduction because of that, which is typical. So what you're really doing is going to be reducing that. You're going to be valuing that reduced amount. You're not going to value what they would have received, because you're looking at what they're going to receive now from the PBGC. So the discovery process and learning about that is going to be a little bit different. You got to go through the PBGC versus this company or that plan, and that's where you're going to find out if there's any reductions.
Okay, and unfortunately we are out of time. What I can do is I can send the rest of these questions to Gerard,
Sure.
and you will be receiving in the follow-up email. I will give you his email address so you can follow up with him directly, and I'll be sending out that slide deck as soon as I receive it. But just wanted to say thank you everyone for participating, and thank you again, Gerard, for being our presenter.
No problem. Thank you. And if anybody does have questions, feel free to email me. I'm usually always available, and that'd be just fine. I'll get this presentation over to Brittany so she can get it out to all of you.
All right. Thank you so much, everyone. And like I said, keep an eye on your email.